This property behind me used to be a 3-bedroom house. It's now being converted into a 7-bedroom Surrey Generous HMO. This is Gareth Wareham. He's taken on the project to manage for an investor from beginning to end. So let's talk about the actual figures. This is the main thing that everyone cares about.
Yep.
Right, purchase price, refurb costs, any additional costs, legal costs, and the most important one, the end value.
Yeah, no worries. So within Portsmouth, purchase price here, this was 280,000 for this 3-bed terrace property. To do a refurb into a full 7-bed, fully ensuite HMO, this was 220,000. Building control approval, that was 1,500. You're looking at your first drawings, which was 6 grand with the architects. You're looking at Gen support with your nitro tax. You're looking at about 5.5 grand for that. Then you've got your 30 grand that you're going to get back at the end. So all in all, you're working out, let's do this on my head now, you can edit
Here we go.
Yeah, so I'd say roughly, if you're looking at bridge finance, market rate, probably about 50 grand on top of them. So all in all, you're looking at 580.
580 all in.
All in. Your GDV, you're looking at 650 to 670 within this area.
Amazing.
Now, reason for that is because you're getting a commercial valuation.
Yeah.
You're allowing yourself to get a commercial valuation based off your Sue Genesis approval.
Yeah.
There is lenders that will do it on 6-bed all en suite, like Kent Reliance, but that's how you're able to really drive up the profit margins.
Amazing. So a lot of people are going to want to know about the planning application phase.
Yep.
It's very confusing for myself.
Yep.
Could you walk us through the step-by-step process of the initial planning process?
Yeah, no worries. So there's 2 distinct things when you're looking at HMO. So you need to make sure it's in Article 4 or if it's not in Article 4, because there's different planning aspects in there. So first of all, I'll start with non-Article 4. So non-Article 4, to allow you to get into your Sue Genesis application, is you would do permitted development rights. So you would convert your 3-bed to a 6-bed under permitted development, giving it its C4 status, and then you would put in a full planning application for your Sue Gen. Now within Article 4, that's different. That stops it. Okay. And the things with that is you would have to put your planning application in. So this is a 3-bed house. It's classed as a C3 dwelling. You would put a planning application in to go to a C4, which will allow you to do a 6-bed HMO. Then you have a separate planning application to go for a Sue Genesis, which is your 7-bed HMO and above.
Most people at home are going to be curious about the costs involved to get through the planning application phase until you get your Sui Generis granted.
Yeah. Okay, perfect. So let's go back to the Article 4, because that's where your priciest part's going to part. So usually when you're doing a 3-bed house, you can put in a full planning application to go straight to Sue Genesis. Now, the thing that's included within your cost to achieve that is what they call a nitro tax. So usually councils will want to see your HMO being tenanted as a C4, so a 6-bed, before you get your Sue Genesis 7-bedroom or above license. But what they will do is, if you want to allow you to do that during your build phase, is there's a nitro tax. And they will effectively charge you for how many additional rooms you've got. So for instance, here 3, and we've got 7, so that's 4 rooms. You get charged a tax per room. And then you also get charged a tax, which is a nitrogen tax, which is effectively for gas and waste and stuff. Now, all in all, you're looking around about £6,000 for an architect to do all of the drawings, structural drawings and stuff if you've got floor drops. But you've also got an additional £6,000 to allow you to do that nitrogen. So that's going to be 12 grand to allow you to go through that planning application to move it from a C3 to Sue Gen in Article 4.
It feels like a bit of a big risk to start with. How confident are you that you're going to get through that and it not be a load of waste money?
Fantastic question. So again, it depends on the area that you're investing. All right. So if you're in Article 4, right, you have to understand what the direction is, because some Article 4 will not allow HMOs at all.
Right.
So there's no point listening to this and going, I'm going to put my application in. What you need to do is you need to look at the HMO density policy for that area.
Right.
Right. So what we did for this property is we looked at a 50-metre radius from the front door, and we checked how many of the properties nearby were run as a HMO. The reason being is the HMO density policy within Portsmouth is 10% of the properties within a 50-metre radius can only be HMOs.
And did you need to get a pre-application, a pre-app for the HMO, or that was enough, that gave you the confidence
That was
you needed?
enough to give it. Yeah. So what we did is, what we're doing when we're searching for properties is we're looking for a house that's in an area that's around 3, 4, 5% of HMOs nearby.
Right.
Because what that percentage doesn't do is applications in progress. Because how you do your searches is you look at the HMO register. You also look at some applications in progress to try and work out of how many houses in the 50-metre radius, how many have got their planning application. So if you do 3, 4, 5%, that then gives you enough window and opportunity to allow you to put your application in and give you confidence that you are going to achieve that planning application.
At what point do you get the architect involved? As in, because it may go either way, is that correct?
Correct. Yeah.
So do you have two different lots of planning drawings, or am I misunderstanding that?
No. So you will have two different planning application drawings for your C3 to C4 and your SUGEN. Now, depending on your risk profile, you might want to do your C4 first and then your SUGEN, so that if you have issues with your SUGEN, you can then rent it out as your 6-bed,
right.
Or you can just run the risk of pushing it straight to a SUGEN. Now, your question, when do we get the architects in? That's straight away when we're starting to do our due diligence before we put in an offer on the property. So we will do our checks on the property, we'll make sure, we'll see what needs to be done, add that in the refurb costs, we'll do our HMO density check, and we'll get our architects here to also basically confirm that our checks are correct, and they will do a feasibility report.
So if you didn't get the property, that's beforehand, yeah?
Yeah.
Then the only money that you would have lost is probably the surveyors and the initial architect's drawings?
Correct, yeah.
Is that transferable to another property? Is that a complete waste of money, or?
It can be.
Okay.
So if you're using the same architects and stuff, you can transfer that. You can have agreements with the architects that they don't do full drawings, or they don't even do drawings, they just give you a feasibility check, which is usually like £80.
Right.
So £80 to
That's
confirm
a small risk.
that you are a go and we're likely to do it, your percentage is high, it's worth doing it.
You're going to do it.
When you're doing it like a £280,000 purchase price.
100%. So I take it with the build cost, it would be the same. You'd have two different build costs, one prior to sui generis and one after?
No, so it'd be the same.
Okay.
So when you're doing your 6-bed, 7-bed, so even though you've got C4 SUGEN, it's going to be exactly the same in terms of the build.
Okay.
So the reason for that is, let's say your SUGEN got declined, that 7th bedroom then becomes a lounge with a cupboard, but it has all of the works underneath it.
Okay.
So that when you keep going for your SUGEN, you can then convert that lounge into that 7th bedroom and that cupboard into your ensuite.
So are you taking in worst case scenario, I imagine, that if that does happen and you lose that extra rental income from the bedroom, you're still going to be whatever X amount, the deal still stacks at that price?
Yeah, exactly that. Because when you're going for development finance, your development finance and how they basically value your project is always going to be on your 6-bed version of your build.
Okay.
Because your SUGEN is going to take a little bit longer to get your planning application. So if you're in Article 4 to get your valuation, the process is to buy this property subject to planning being approved.
Okay.
Then the bridge company can then give you a proper valuation, and on day one you get your funds.
Right.
Otherwise, what will happen is a bridge finance company will help you buy this. You won't be able to do anything for 2-3 months waiting for your planning application. That costs you money and interest. But then you get your planning application, you get moved to a development fund, which again is going to cost you more money in terms of solicitors, costs and everything like that, and another valuation, and then you get moved over.
So let's talk about the stages which you would not only apply for the bridging finance, but you'd also get paid from the bridging finance company in order to finance this and then pay the builder. Okay,
so two aspects. So when would I start my conversations with a bridge finance company? Straight away. Okay, so let's say an estate agent calls me up and says, right, I've got an off-market deal, do you want to come and see it first? Yep, perfect, say it's this one. I'll go and do my due diligence, I'll check that it's got its HMO density because we're in Article 4, I'll make sure everything's fine, contact the architect, they'll do the same as well, I'll then contact the bridge finance company.
Okay.
I'll then tell them the purchase price, and I know what the refurb cost is going to take with regards to, it's going to be about the 200 to 220 mark, depending if I need to do double floor drops. So I have a sheet of what things are going to cost that I can give to a finance company and just say, right, this is what we need to work our numbers off.
And then you were telling me earlier, the first initial investment would come from you or your investor.
Yeah.
And that's almost a guarantee, or to the bridging finance, you've got some skin in the game.
Yeah, so this is at the stage that you've bought the property, you've started the development, and when you get your development funds. So one thing that people need to really take into consideration is when they ask how much capital you need £30,000 or £20,000 or 50 for that first invoice. Okay, so what a development finance company would do, say you're development finance, you say, right, Gareth, I'll give you 200 grand.
Yeah.
You're not going to give me 200 grand straight away.
Of course not.
So to give you confidence, I pay my builders 50 grand. I then say to you, can you come bring an asset manager to show that I've paid for the work and the work's been done? They then come and sign it off, and then they allow and give a drawdown approval, and then that's when you get your first 50,000. That gets recycled every time till the end. So
let's talk about now finding a good builder, because not every builder can do a sui generis transformation like this.
Yeah.
This is a big, it's probably the best, if not the best HMO transformation I've seen.
Thank you.
Best builders, definitely the cleanest site. It's impressive straight from the get-go. How did you find quality people that you can trust? Well, there's always an element of, who knows?
Yeah.
So how did you find these guys, and how's that process been?
It's really important that you speak to builders that have done HMO developments before.
Yes.
Okay.
No-brainer.
You cannot just go to a normal builder and say, right, can you do this for me? The reasons for it is a HMO builder will understand all of the building regs, the fire regs, the electrical and stuff like that, which really helps you as an investor remove some issues. So how to find them? Go onto Google.
Yeah.
Go into the area, right? Try and do a Google search with regards to people that are online. You can even do like Trek or Trade or anything like that, looking at sort of reviews. What I did for Empire Contractors Limited, who are a fantastic company, done over 50 HMO properties in and around Portsmouth, is I actually went to some of their sites. I went to their office.
Yeah.
I was like, okay,
Makes
show me
sense.
what you're doing.
Yeah.
Show me the plans that you're actually working on. And then from there, we then built that relationship where it's like, okay, you guys know what you're doing, you're on time, get it done.
So these guys are 2 weeks ahead of schedule, is that correct?
2 weeks ahead of schedule.
That's pretty unheard of. I used to work in construction a long time. It normally always goes over. Why do you think you're 2 weeks ahead of schedule? There's obviously a good working relationship here. Like, what is any advice you'd say to keep on track, maybe within the schedule?
Yeah, so you as an investor, when you give it to the contractors, that doesn't mean that it's no longer your job.
Sure.
Okay?
Yeah.
Perfect application,
Good bit of
WhatsApp.
advice, yeah.
WhatsApp's perfect.
Yeah.
Create a group, name whatever you want for the group, put the main contractor in there and you. Come down to site once, twice a week. At the beginning, don't tell them the days that you're coming down, so you're really testing that their communications are correct.
Yeah.
Also ask for weekly updates. So what we do on our sites and what I do is I ask for every Friday, I want photos of what's been completed for that week, and then a commitment of what we're going to complete the week after.
Right.
And then from there, I can then track it nicely, as well as when I'm doing my scheduled works and drawdowns, that we're completing things to plan, we're getting things done. It also depends on deliveries, right?
Right.
A lot of the stuff is deliveries.
There's going to be delays.
There is going to be delays, but that's why you've got contingency within your plan. We've been lucky here that our deliveries with materials have been on time. We haven't really seen any issues, and that's probably commitment down to the guys and who they work with. So that's why we're 2 weeks ahead.
So the last question, I wasn't even aware a short time ago that you could get a day one commercial valuation for pretty much, or is it all sui generis?
Yeah.
Do you want to talk about that?
Yeah. So a lot of concepts when you're doing like training and stuff, and everyone advises you of different strategies. So as an example, service accommodation. So if you do a BRR to a service accommodation, we obviously know that it's fantastic, better than a buy-to-let, because it's cash flow straight away. With that, to get a commercial valuation, you need 2 years worth of books to allow you to get that status. With a HMO, you get day one commercial valuation. Okay, so you've done all of the build, you've had building control sign off, you then go for the refinance. You're getting a commercial valuation straight away on refinance, which allows you to pay back all of the bridge costs and all of your capital at the beginning, which then makes it pretty much, in some scenarios, all money out deals, or easily 25 to 35+% return on investment. And that is why people are doing them.
I told a lie. I want to ask one more question because I think everyone wants to know. Most people focus on the BRR strategy, and they often forget, you know, that the reason we get into houses, or property I should say, is because of the capital appreciation. That's the number one reason why people get into property, generally speaking.
100%.
Second is the cash flow. In this instance, even if you left money in the deal, can you explain what the benefits are long term, why people shouldn't only focus on all money out deals?
Yeah. So capital appreciation. So with this model, you do have to be a bit careful, right?
Sure.
What you don't want to do is build a portfolio just of commercial valuation HMOs.
Okay.
Because then you are over leveraged. Right. And the reason for that is when you try and sell this HMO, you're not going to sell it for the commercial valuation.
Right.
You're going to sell it for bricks and mortar. Unless you get tactical and sell the company to an investor. Right, so there is ways around it, but you need to be aware of that.
Right.
But the main aspects there in your question is, why should people really focus on capital appreciation? So if you look at data, it's been proved that houses double every 10 years, right? That's your money. That's within a asset class that there's obviously risks of the house market crashing or whatever, but you're keeping it within a bricks and mortar asset class. So your capital appreciation with a normal BRR to a smaller HMO that you can't get commercial status, and that's off bricks and mortar, or your SA or your buy to let, they're going to obviously grow in 5 years, 10 years time, while also a tenant is paying for that money and you're getting cash flow through the rental income.